we are going to just jump right into this webinar and, just start with, the reasons why to get into, the commercial world. So.
Quick intros first. So I'm Colton Smith. We're both out of Salt Lake City. The way we work is that Derek and I both, we are loan originators currently. We've combined closed over $6 billion in commercial, mostly commercial real estate investment property related loans, but also owner user and business type loans. I currently work for a company called Walker & Dunlop. If any of you know, Walker & Dunlop is one of the largest commercial mortgage brokerages in the country, as well as a direct Fannie, Freddie, and HUD multifamily lender. And I've been doing this for 22 years now, quite a long time. So it's a passion of it's always business, but it's a passion of mine as well. And Derek has his own firm.
Yeah, so I have a boutique commercial loan brokerage called M5 Commercial Funding. Been doing commercial loans over 10 years and have a small team that, we do a lot of commercial loans, all different types, everything from, SBA loans to, of course, agency to much larger CMBS life co loans. So.
First question in already is, will we receive a replay? You should be able to access it on our private Facebook group called Commercial Loan Launchpad. So go ahead and go on there, and then once we have this cleaned, we'll upload it there or give you access that way. So
yeah.
Okay, let's get into the meat and potatoes here. If I could figure out how to get back to it. All right, secrets of high yield commercial loan origination. First, we just wanted to explain the common differences that we hear residential versus commercial, and the big differences that we hear on a daily basis. So residential, obviously much smaller loan size. Borrowers are emotional. That's what we hear from most of you that you don't like, the emotional borrowers. There's a ton of competition. The markets are saturated with commercial loan officers or mortgage loan originators, however they want to title themselves. And so there's a lot more competition. You qualify those loans primarily based off of personal financial strength, running your DTI and doing those spreads. They are long-term loans, which is actually good, 30-year loans, obviously. They run by a wholesale lender model, and this is important as we go through because the commercial does not do that. Here's what we see the differences on the commercial side.
Yeah, so commercial side, loan sizes tend to be much, much larger. The average commercial loan is right around $5 million across the country. And so, you're doing a lot larger loans. And then, so like I mentioned, $5 million average commercial loan. It's investor focused. So the borrowers, they're typically, they're doing their underwriting, their in-house underwriting to see if it meets their investment goals. They're penciling the numbers and doing that. So there's much less competition. There's not a lot of commercial loan brokers out there across the country. Qualified by property income. And so the property will justify, the loan amount and, which is the LTV and much shorter loan terms. So typically in the commercial world, it's a 5, 7, 10-year fixed term. And so every 5, 7, or 10 years, these loans are rolling and they, will need to refinance. And so you have a lot of repeat business. So, and then an open market lender model. So in the commercial world, we don't have a wholesale. We don't have to sign up with a particular lender to be able to, access their loan programs, and which makes it nice. So, and easier to, shop deals.
Scott, I saw your hand raised. If you want to unmute, is that you, Scott? Yep. Thanks.
Hey, real quick question on commercial. is it basically a 30-year AM, although you do have the 3, 5, 7-year terms?
Great question. Yeah, we'll cover that
Oh, you will?
in
Okay.
about
All right.
5 minutes. But yes, they're actually anywhere between 15 and 30-year AM, depending on the deal. But most of them are around 25-year amortizations.
Very good. Okay. All right. I'll hush
All
and
right.
let y'all do your thing.
Yeah, good question though. Thanks for the question. Here's the market potential. So there's a company called MSCI Real Estate Assets, and they do a lot of national data analysis within the commercial market, and they collect a lot of loan data, and they're probably the leading source of loan data collection in the commercial real estate world. And they show over $1 trillion. That's 1 trillion that they see coming due within the next 2 years. And these are, based on what Derek just said, the natural loan maturations, the loan balloons. Over the next 2 years, we're going to see $1 trillion in commercial real estate. I mean, that's 1 to 2% origination fee. That's $100 to $200 million of commissions that will come our way over the next 2 years, just in that category. There's a bunch of other categories of refinancing by necessity, whether it's to buy out a partner, a partnership divorce, a capital event, a refinance, discretionary refinance, and a bunch of other reasons why you're going to see more than $1 trillion worth of loan maturities. I mean, loan refinance opportunities coming through.
Yeah. Just to reiterate what he mentioned, these are balloon loans, so they're not, ARMs, which you're familiar with. Most commercial loans, they are balloons, so the borrower will need to, either refinance, sell the property, but most of them, they like to retain the real estate, and so it's a good time for them to, access some of the equity. So there's a lot of, especially right now, a lot of cash out refinances that are happening. So.
Wayne, let me address your question right now, since I know that's a question that probably on most of your minds is licensing. First and foremost, we're not lawyers, so our information here is not, you can't take this as the final word. You need to check with your individual states. That being said, is that we have been informed by many sources, and we know this through course of business, that there are over 40 states in the United States of America that do not require a license at all to transact in commercial lending. And every state's going to be different. Wayne, it looks like you're from California. We did find out recently that California, you do need a DRE license, a division of real estate, so a sales license, in order to do commercial loan brokerage, which is funny. Thanks, Gavin Newsom, I say to that. But outside of that, most other states that require a license to do commercial, it is the same license as your residential NMLS license. So there's no additional licensing required.
Sorry to interrupt. Off the top of your head, do you know if Texas
is a very red state, my friend, and so Texas is pretty open, as far as I understand. But again, check with the division. And thank you, Christian. I think you're correct in what you posted. No, those are the ones that do require less licensing. California, there's some question marks. So long story short, make sure you talk to your division of real estate, and get those answers before you transact. But there's a lot of ways that you could do commercial real estate actually without having your license above board and legal, and that's more for your attorney to make sure that you're doing correctly. But overall, it's a very open market, and very easy to get into the market. You just need to understand where to go. This is the cool part. Income potential. Income potential obviously is much larger because you have much larger deal size. So in commercial, your average loan fee is between 1% and 3% of the funded loan amounts. Guess what the average commercial loan size is across the country? Anyone have a guess there that you want to throw on the chat? I'll give you 5 seconds.
We mentioned it before, so.
Yeah, that's true. You already have the answer. Okay, fine. We'll just show it. $5 million. Depend, and that's from multiple different sources. Some will say higher, some will say lower, but so we use kind of the average of what's been reported. The reason it's not known exactly is because there's too many non-disclosure states, and commercial real estate in general is not reported, and they don't have the regulations like residential does. And so that's the best guess across the country is $5 million. If you do one $5 million deal a year, you can make up to $150,000 in commission on that one deal. We're going to show you some examples here soon. So the question is, how many residential loans do you have to do to make $150,000 in commissions? Throw that on the chat. I want to see what everyone thinks.
Say that again.
How many residential loans do you have to do in order to make $150,000 in commission? Linda said one. Brian said one. Good. You're doing $15 million or $7.5 to $15 million residential loans. That's great. 20 is 20 to 30, 35, 40. If you run, and it really depends on the state you're in, right? And the type of business that you're in. But if you're just going on averages like we're using here, the average residential loan size in 2023 was $329,000 and change. If you got 2% on every $329,000 loan, which most don't, but let's pretend you do, that would equal over 22 loans in a year just to make the same that you would make from potentially one deal on the commercial side. So that's the income potential. So if all you do is supplement your income by doing one deal, and let's say you make the least amount possible, make 1% on that, that's still $50,000, pretty good. That's a pretty good supplemental income, I would say, if you could learn how to do that. All right, so on to the kind of the bigger topic of everything. What is the overall, what are the secrets essentially? How do the top earners make their 6 to 7 figures? Here's what we've come up with. First,
so identify your market. What borrowers are you going to target? What property types are you going to target? You have to set your market large enough that you're not just working in a small niche market in the middle of nowhere, Oklahoma. Go after borrowers, property types like multifamily, self-storage, even gas stations. Just know what market you want to target.
I'm sure you've heard for years that find a niche in real estate and focus on that. This is one of the things that it's a rare exception with commercial financing. Yes, you still want to focus more, but you still are able to cast a semi-wide net. And like Derek said, if you want to focus on self-storage, that's great. Focus on self-storage, but you don't have to focus on self-storage only in Orange County, New York. You could focus on self-storage in New York and all the neighboring states or the entire country if you want. I have a lot of friends that do single tenant net lease financing only, but they do it nationwide and they do about 200 to 300 deals a year just in that aspect. And so there's different, a lot of opportunity there for that. Moving on to the other secrets here.
So find active commercial real estate investors. So we've all know about multi-level marketing. You find 3 people and those 3 people find 3 people. And it's kind of similar when you're working with, real estate investors, because, you find one active commercial real estate investor, they're typically buying 3 to 5 properties a year. And the nice thing about these investors, if the numbers work for them, they need financing and they need help getting these loans funded. And so if you find one commercial investor guaranteed 3 to 5 loans, you find 3 there again, it's 9 to 15 loans, and there again it's just multiplying. And so it's good to have these commercial real estate investors as as partners, as friends, you're working together to help them get the funding that they need.
This probably is, we didn't even plan on talking about this, but this might be the biggest secret for these top originators, is finding that repeat business. And that's one of the largest differences between residential and commercial. If you're doing just typical residential, you do a loan for one client once in a lifetime, maybe twice, sometimes three if they move a lot. But if you are working with commercial real estate investors, they want to buy 3 to 10 deals per year. And so not only are they, you have an opportunity to transact with them on the acquisitions, but they're going to find a capital event, meaning they'll want to refinance potentially all the previous deals every year. So you have many, many, many deals per one single client every year, potentially. And so with that math, if you have one client that does 3 deals a year on the average deal size, 5 million, that's $150,000 or $15 million a year just from one client, $150,000 minimum revenue from that one client, up to $450,000 revenue from that one client. So the name of the game, find as many of those as you can.
All right, next, build relationships with at least 50 commercial lenders. Now, these commercial lenders, they may not just be in your neck of the woods. They could be all across the country, because most commercial lenders are either, regional or, just state specific. And so you want to have at least 50 commercial lenders, all different types of lenders, lenders that are, they'll do the traditional vanilla type commercial loans to, those that'll do the more, specialized SBA or, niche property types that are, hotels and self-storage projects. So
that is a major difference that people notice within residential, that when you go to commercial, there is no united wholesale mortgage in the commercial world. There's no one size fits all lender for most any property type, let alone all of the commercial lending world to begin with. So just to let you know, I close with about 30 lenders every year. And I almost never close 2 loans with the same lender in any given year. Sometimes it happens, but it's very rare. So your lender relationships are extremely key here.
all right. Next, you need to become familiar with the loan programs for your target market. And so going back to your target market, what property types and investors are you going to go after, and what loan programs will best suit them? And so, there's a handful of loan programs, but there's also a handful of property types. So you want to make sure that the loan programs will match up to, the different, property asset types. And, that will help, speed the process, getting loans closed. All right, next, know your competition. So in the commercial world, who are your competition? Sure, there may be a broker or two out there that you might be competing against. Colton and I, we've been friends, neighbors for a long, long time, and we have never competed against each other with the same client.
We're literally 10 houses away from each other, been in the same industry for 15 years and never competed against each other on a single deal. That's how unsaturated, if that's a word, the commercial market is. There's so much opportunity there.
So, all right, provide value to your client on a regular basis. And so, what your clients want to know, of course, is probably the same in the residential world. They want to know what, rates and terms are, but they also want, your advice on, what properties and what investments are doing well for their other clients. They also want to know, what loan programs will best suit them. You become more of an advisor to your clients than just a broker. And so, when they are looking to get financing and you're shopping the loan for them, you create a loan matrix where you can show them the different loan options and give them, the pros and cons to each loan program.
Okay, let me answer a couple questions before we move on. EPO is a big question. I didn't even know EPO existed until I met residential loan officers and started doing business with them. So that means no, it does not exist in the commercial world. EPO's not a thing. So that is not an issue whatsoever. The other one can, one be an independent commercial LO on their own, or do you have to be employed by a commercial loan company? Again, that is state by state regulated. So in many states, yeah, you could do it independently. In fact, in all those states that you don't have need to have a license, I believe you could do it independently. Those ones that require a license are going to have different regulations there. And I love Juan's comment. He loves commercial lending because RESPA regulations don't apply to them. Yeah, I mean, all the terms that you're using on a regular basis in residential, RESPA and truth in lending, and even FICO score and DTI, that stuff doesn't exist.
Non-existent.
It's you're dealing with accredited investors, and it's a different world, which is a lot more fun. Okay, moving on.
All right. So underwriting considerations when doing commercial loans. So the underwriter, they want to know, the property income and not necessarily the borrower's income or credit score. Those are second or even third factors when it comes to underwriting the property. The main factor is going to be, the property income, the NOI, what does it generate? And that will determine, the loan amount. And so you might hear, borrower's getting 75% LTV on this commercial property. Well, he's getting a screaming deal because it all comes down to the income. We do a DSCR calculation, and that will change depending on, the property type, location, and class. But there again, the property type. So, if you have a hotel, the underwriting is much different than a multifamily, apartment complex or a medical office building. And so they also consider the leases and the tenant type and the tenant strength. So if you have a shopping mall and you have triple net leases, I don't know if you're familiar with triple net leases, but those tenants are paying all the expenses on the property. That's a much stronger investment for the borrower, but it's also an easier deal to do because you don't have to factor in all the expenses because the tenants pay for all those. So
general loan terms, Derek already mentioned 5, 7, and 10-year balloons or maturities. They are not typically ARMs. There are ARMs in commercial, but they're fairly rare. Most of these mature. So it's a hard balloon, stop, maturity, whatever you want to call it. After 5, 7, or 10 years, there are variations. Some will do 1, 2, or 3 years. Some will do 12, 15, 20, even 30, 35 years. But the vast majority of loans are these shorter term, 5, 7, or 10. The reason being is that most of these borrowers are investors and they have capital events, whether it's forced or voluntary, where they need to or want to refinance or sell within a 5 to 7 year period, typically. And so that's why they're structured that way. As was asked before, amortizations are mostly 25 years. Apartments will usually do a 30-year amortization, most lenders will. And then there's some different property types that will require 15, 20-year amortizations, but most of them fall in the 25-year amortization. So a 5, 7, or 10-year term with payments spread over the 25 or 30-year period is what that essentially means. Rates are tied to a 5-year or 10-year treasury plus a spread. And that spread right now, depending on the lender type, the property type, and all the underwriting, ranges from 1.5% to 3%. So this morning, I think the 10-year treasury was 3.8%. So that would put your 10-year loan rates anywhere between 5.3 and 6.8%. And most of them, good and stabilized properties fall in that smaller range right now, that lower range in the kind of low to high 5% range, which is phenomenal. Many of you may know other quote unquote commercial lenders out there that specifically market to you as MLOs, and their rates are 9% plus. Some might be 7%, but most of those advertise at 9% plus. That is not the norm. Those are very high interest rates for commercial lending right now. And then there's non-recourse options available under some loan programs within commercial, meaning you do not have to provide tax returns, whether it be personal or business, in order to finance some of these properties. That means the first source of repayment is actually the property itself. And so the underwriters underwrite to the property income, not the borrower strength and financial income. That is a major difference, and there's exceptions to that as well, obviously, but that's usually what it is. Okay, here's some examples. Let me just look at the chat really quick to see if there's other. Someone said, tell me about SBA loans. How much time do you have? We don't have that much time. SBA loans are great for owner user. As a summary, there are 2 different loan programs within the SBA, but they are meant for owner operated properties that operate 51 per or occupy 51% or more of the property. And those rates range from 6.25% to 11%, depending on what you're looking at. Someone mentioned DSCR. DSCR was mentioned. Are these loans typically a light doc or no doc? Some of them just depends. All investment properties, they are underwritten by lenders based on DSCR, all of them. So this is a DSCR type loan, but it's on steroids, meaning there are anywhere between 20 and 40 different categories that have to be underwritten in the income and expense statements for the properties in order to come up with the NOI, net operating income, to derive the loan amount on based on the debt coverage ratio. And every property type has a standard or kind of a generalized debt coverage ratio minimum, and every different lender and lender type have their minimums for each property type and loan type that they are doing. Construction loans, yes, we do construction loans all day long. We do permanent loans, which are your conventional stabilized loans, and then we do bridge loans, and then we also do mezzanine and equity as well. So a lot of things to be done there. How heavily is credit score? I assume how much does credit score factor into that? Our other massive advice is do not lead a conversation with a commercial lender with credit score. Do not do that. Credit score may be factored in, but in the non-recourse loans, it may never be factored. They may never pull the credit. If anyone pulls credit, it's usually at the end, towards the end of the loan, not at the beginning. Linda asks, so are you technically a commercial lender? So technically, yes, Derek and I both are together own a private lending company where we do private money loans for commercial properties, commercial borrowers. And then the corporate company I work for, we are technically a direct lender for Fannie, Freddie, and HUD apartment loans. And we are a balance sheet lender, meaning we have $2 billion that we spend on or lend on an annual basis. But primarily, we are brokers. We are commercial loan brokers. And that's where the money is actually made, because your entire market is open. You could finance any type of deal anywhere in the United States for the most part. So we'll move on and address other questions a little bit later. So here's some examples of recent deals that Derek and I have closed, and kind of just to get you an idea of the type of fees that we have earned this year and that are available and still moving forward.
Yeah, so this property right here, just a quick summary. It was a developer. He was coming out of construction and needed permanent financing. So we went from construction to perm. It's a mixed use property. Loan amount 2.9. Got him a pretty decent interest rate of 6.25. And you can see, we charge 1%. He's a repeat borrower for us. And so another one. This was an SBA loan for a medical doctor, and so there again, SBA 2.4 million. We made 2 points on it, 49,000. So Northern California hotel, there again, purchase 4.8 million. SBA made 2 points on it, 72,000. So here again, a large apartment complex. It was 29 million, almost $30 million on Fannie Mae, and made 1.5 points on it, $448,000. Crazy. So,
industrial building here in Utah, where we are in American Fork, that was a construction takeout loan, and we got 5.42% with life companies. We got a 30-year amortization on that, which if you Paid attention, 30-year amortizations are typically more for apartments, but in this case, we got it for an industrial building and made 1%, 128,000. This is an apartment complex also with Fannie Mae. We got under 5% at this time. $23 million, only 1% fee on that. And I say only because you'll see coming up here. This one just closed this month. This actually, the fees are backwards. This one closed this month. No, sorry, this does close this month, and this closed with an FHA loan. We were the direct lender, and we made, actually, this loan fee, the interest rate was 5.65%. The 4.87% that you see on that was actually our fee. So we made almost $1.5 million on this deal. $1.5 million on one deal. Okay. This last one, this was a 2% fee on a Fannie Mae deal, $19.5 million. Another multifamily construction takeout loan that we did with Fannie Mae, non-recourse, and made 2%, $391,000. Hope you're getting the idea of how much fee can be made on any sort of deal, and I hope you're getting stars in your eyes to be able to close big deals, because when most residential LOs think of commercial, they're still thinking $1, $2, and $3 million, which is nothing to sneeze at. That's good and much higher than the average residential loan size. But I will guarantee you that this $19 million loan right here was much easier to do and close, and much less hassle and quicker than most of the $1, $2, and $3 million loans that you come across. Okay. This is from our personal experience, and this is we're kind of this is our passion. Derek and I both started in the residential world and went into commercial, and what we found out is that it's not the easiest to transition from residential to commercial, and here are the reasons why. Most people, and this is from our own experience and from basically your experience, people that we've talked to, MLOs that have tried and either made it or even failed. Here's the big differences.
Yeah, they just don't know where to find clients. So they come across a handful of clients, every year. However, there are many clients out there that are looking for, commercial loans, and they don't even know where to go. Banks and credit unions, of course, are an option for them. However, they have such a small bucket of property types and locations of what they can do. A lot of clients just get turned down, and so a lot of residential LOs just don't know where to find clients. So, and another thing is they don't know the loan programs. They get a lot of LOs, they get marketed to by the pseudo commercial loan companies that are lenders that will do they'll do a single family home, or they'll do a small apartment complex under 2 million under an LLC. And they, a lot of LOs think that those are, true commercial loans. Those are pseudo commercial loans. Loans, commercial loans, of course, they go down to $500,000 or so, but they go much higher than 2 million. 20, 30, 40, 50, even $100 million, is not a problem in the commercial world. So
we just closed a $250 million loan this year as well. The sky's the limit in this world, just so you know.
So
they don't know the right commercial lenders. This might be the biggest one that we hear mostly from all of you. In fact, I did see in the chat, I'm not ignoring you, Scott. Maybe I am a little bit, but they don't know the lenders. This is the #1 complaint. And as you know, similar to the residential world, our lenders are our secret sauce. So if we advertise our lender list to the world, then it minimizes our ability to do our job. So I hope you could understand. But there is an option that we have to get you some lenders, but this is a big problem. They don't know where to go. Most of you get marketed to, like Derek said, by a couple pseudo commercial lenders, and they make you believe that those are really the only commercial loans out there. Obviously not true. There are literally hundreds of lenders and multiple different types of lenders across the country. And you've got to know at least 50 of them to be able to service the majority of the deals that you will see. They don't know underwriting guidelines. That's a huge one too. We touched on it really quick on the DSCR, but that's just a fraction of what you need to know as far as underwriting differences between residential and commercial. And it's a learning curve, obviously. So it's important to understand the difference between underwriting residential and commercial.
Yeah. They don't know the loan process. You know, there's some similarities between residential and commercial. However, the loan process in commercial is much different, especially on the originating and processing and underwriting portion of it. You know, the closing part where it comes through, you know, the title, you know, and you know, closing loan docs and, you know, arranging insurance and stuff like that. Of course, it's very similar, but you know, everything else is much different in the commercial world. All right, the tools, the forms, the tools, and the whole process in the commercial world is much different. They just don't, a lot of residential agents don't have those. So they can't give the borrowers, you know, a quick idea of what loan amount they can get to, or where interest rates are at, or what's needed to even start the whole commercial process.
And finally, this is very important to me because I was a victim of this. When I went from residential to commercial, I did not have a mentor. I didn't think I needed one. I went to an institutional commercial real estate brokerage, and they gave me a phone and a desk and said, good luck. And it literally took me about 4 years to figure out how to do everything we're talking about here. So with mentorship, with someone that can mentor you or guide you along the process, you should be able to cut that time down to less than 6 months. And so I wasted 4 years, essentially, or 3.5 years, if you will, of huge earning potential because I thought I could do it all by myself. And with that said, we do, you know, part of the purpose Derek and I are very passionate about teaching and coaching because of the experience that we went into. When we went into commercial, we did not have the tools and ways to be successful. We know they still don't exist out there, and that's why we created a program called the Commercial Loan Mastery.
Yeah, so the Commercial Loan Mastery, we have condensed the Commercial Loan Mastery down to 3 full days. And the nice thing about Commercial Loan Mastery is you learn everything you need to know from start to finish on how to market, originate, process, underwrite, and close commercial loans. And so it's a 3-day weekend, and you become a certified commercial broker. We're able to do all the different loan programs, property types, and help your clients in making great money doing commercial loans.
I'll put in the chat right now the website to go to apply if you're interested. You could either register or book a one-on-one call with us. We'd love to talk to you one-on-one to kind of help you understand how it would benefit you in your personal business, actually. So that's what we prefer. We only prefer people that you know, really are intent on doing commercial as either a huge part of their current business or actually fully transitioning from residential to commercial. Either way is just fine. And so if you're interested, give us a call. This is on the website. It shows all this as well. But other the key things that we give you that you guys were interested in is we do give you a list of lenders. And it's a lot. It's actually over 500 lenders that we give. We give you all the templates that we were talking about, the templates to underwrite, to process, legal templates, and everything in between. And then we give you a list of leads. So current commercial loan investor owners in your market of choice, we'll give you a list of 100 leads that you can contact directly and start building your business off of. And then we help you close your first loan so that you can be comfortable in the process and go on from there. All right, let's go to the Q&A. Let me answer a couple from the chat. If we have some, I'll probably miss some. Linda had to jump. Sorry, Linda, you missed. Is comp all borrower paid only? For the majority, most true commercial loans, compensation origination fee is borrower paid on the settlement statement. There are only a handful of lenders that will pay you yield spread on the back end. But almost no one, with a couple exceptions, is actually lender paid compensation. So that is typical in the commercial market, and not, your commercial borrowers will know that already. Wayne says, I work with a small boutique mortgage banker and approved for Fannie Mae, Freddie Mac, FHA, and VA. However, we are non-delegated. How does that play in finding financing with Fannie and Freddie? They're completely different. So your approval with Fannie, Freddie, FHA, VA has nothing to do with approvals with Fannie and Freddie on the multifamily side. That is a completely different licensing and approval, and only 26 lenders in the country have that licensing. And there are no new licenses to be given out, so you can't just go get licensed. So that is there. You have to work with a lender directly that is licensed, like us. Raw land lenders in Canada. Sorry, I don't think I have any, Todd. In Canada, we try and stay away from Canada.
I mean, you can go to BMO.
Yeah, BMO. I mean, the TD, BMO, the banks, the large banks in Canada will do that kind of stuff. Someone else said Doug had to jump off. Okay. I think I got all of them in here. Do we share comp with you? No, you don't have to share comp with us. We're teaching you how to do this yourself. Now we are here actually that's a good question, Richard. So we are here. You can refer deals to us. We will get them done and we will close them, and we will pay you a referral fee for doing that. Typical referral fee is about 15% in the commercial world. But for a name and a number for you to receive a, check for, $4,500 or, 45,000, whatever it might be, that's a pretty good gig. So we are here if you want to do that. Nathan said, doesn't Colliers have an office in Canada? They might, but I don't know if they have lending. Actually, Colliers typically does not have a lending arm. They did just buy one, but it's only in the United States as far as I'm aware. So let me leave it off to you guys. If you have other questions that you want to unmute yourself, raise your hand, we'll call you, and unmute yourself. You could ask other questions that are on your mind. No questions. Love it.
Hello, can you hear me?
Yes.
Your contact info, please.
Oh, yeah.
Well, that's important now, isn't it? We usually have a slide for that.
Thank
I'll
you.
type that in there. So while I'm typing that in there, if anyone of you have questions for Derek, because I can't multitask today, let's go for it.
All right, so we're getting a few questions on the cost of our 3-day event. So our 3-day event is $5,000, and we priced it so you do your first deal, you'll get your investment back plus much more. However, since you all jumped on this webinar, we have special finance, or not special financing, but a special offer for you all. So it'd only be $4,500. And if you want to come as a team, we even have additional discount for those that are looking to come 1, 2, or 3 people. And so, yeah.
Phenom, you asked where you go to register. I put that website on here, www.commercialloanmastery.com. You could register directly there if you'd like.
Yeah. And so also if you want to have a call with either Colton and I, or someone on our team, you can go to Commercial Loan Mastery, and we can jump on a quick call with you and discuss how this program can specifically benefit your current business. We understand that this program is not for everybody. You might have an incentive to get into doing commercial, and because you come across a lot of commercial borrowers. But in our course, besides learning everything that you need to know to become a commercial loan broker, we also have the marketing, and the marketing works. So our marketing helps generate lots and lots of deal flow, for those that come to our course. And so.
Okay, yeah, like Derek said, if you want to jump on a call with us, email us, we'll send you the links that you could schedule with one of us directly and work with you there. Is training mandatory? I understand it may be recommended possibly for you deals into training is not mandatory, but the problem is, Wayne, and that's a phenomenal question. 99% of MLOs that we do deals with, without the training, we have to hold their hand and spend a lot more time with them. And so we designed this class so that it's a streamlined process for both of us to make money. So after you go to the course, you now know what we know, and so it's a relationship that that flows much better. And we trust that when we get a deal from Charlie or we get a deal from Phenon or Brian or whatever it might be, that it's going to be a good deal because they will have done the upfront underwriting that we teach you to determine whether or not it's a good deal. And then the other kind of it's a reality. I don't mean to sound rude or mean or anything, but it's a priority thing. And so when you don't go to the course and because of the time we have to spend on it, you probably drop down a little bit on the priority list. And we'll try and get to you, or we like business, right? But we'll try and get to you, but it's a little bit tougher road. But the benefit on the other hand is after you go to the mastery course, if all you want to do is refer us deals or any deal you want to refer us, we do double that referral fee to 30% for that, again, because of the ease and communication of working together. And so that's kind of the trade-offs that we give. But yes, if you want to work with us and send us deals, and we'll absolutely get to the deal and work with you on it. But on that too, and we should have had a slide for this too. If you do want to send us deals, it is a minimum $1 million deal size. And it's a single purpose building. So it could be multiple tenants. So for example, we want an office building or an industrial building that is just industrial or just office, and an apartment building that is just apartments. Oftentimes we see deals that are apartments with an Airbnb and maybe a salon and like 5 different things. Those are very difficult for your information, when you see them, but also for us as well. So $1 million and above. Current existing property, no land, no construction, current existing property, refinance or purchase. If that's what you have, we will definitely work with you on those deals.
Yeah, so Richard asked, how do we pick the cities that we go and do our commercial loan mastery? Great question. So we do one of these commercial loan mastery courses in a different city across the country every month. And so we typically bounce from the West Coast to the East Coast to somewhere in the Midwest, and there's, I guess kind of what we like to do is we like to go into bigger cities where if people are traveling, it's a bigger hub, so people could fly in. And
it's based on demand too. So when we do these webinars or just through course of business, we get calls and emails from people and we start seeing trends from different markets. And so we're like, okay, like we were just in Miami, and Miami is a hotspot market-wise commercial market, and so we went to Miami to be in their backyard to help them with that. So there's a lot of different factors, but also the DMC. Since the DMC was in Chicago, we're like, yeah, if it's good enough for Kamala, we'll go, right? I'm just kidding. Just kidding. Just had to throw that since we ended today at the DMC. So good question. All right. One last question, maybe. James, we do not have a scheduled event for the beginning of the new year yet. We are working on that, so we will figure that out. Thank you, Nathan, for understanding my joke there. I appreciate that. Not everyone does. So no, yeah, we will roll them out. So keep that the website handy. And we will update that with the new events as the months come along for the coming year. How do we contact you, Wayne? We did put our email addresses and website above, about 5-6 inches above in the chats, so you can grab it from there. And we'll also probably just send you a thank you follow-up email and with these links and our contact information as well. How'd you get signed up, Chris? Go to the commercialloanmastery.com. And you could sign up there. If you have a specific location, Chris, based on the 4 that we have coming up that you want to go to, you could also email us and we'll arrange registration for you as well. Concierge service.
Nice. Hey, I want to thank everyone for attending our commercial loan mastery webinar, and we'll be having more and more webinars coming up. And so if you're interested in knowing more about our different webinars that we'll be having, drop us an email, and we'll be sure to make sure that
we'll keep you on the list, and we'll have DSCR webinars, we have SBA webinars. Someone asked about that. We have various different topics, and today was more of a high level overview for you to understand kind of the huge differences between residential and commercial. And we appreciate you guys staying on and asking great questions. So we'll leave it here. Philip we will send you our contact information as a follow-up. So thank you everyone, and have a great weekend.
Yes.
Talk to you soon.
See ya.